all credit bubbles come to an end. They pop, and when they burst, they usually burst quite spectacularly. If you see the value of gold expressed in fiat currencies rising, so long as energy prices don't rise more quickly, that's going to be good for mines. Also, bear in mind that most producing mines, they will be managed through this. So what that means is that they will extract lower grades while they are profitable, rather than the higher grades. So the idea that you can translate immediately a higher gold price into higher profits, I think you've got to temper it a little bit and just understand the reality of it. The other thing I would say is that gold is hardly owned. It's less than 0.5% of all portfolios, if you like.
In today's gold's headlines, Morgan Stanley says gold's rally will likely go on. Gold broke a new record high on October 10, surpassing $4,000 per ounce for the first time and continued to climb since then. On October 21, the rally hit a wall with a drop of as much as 6%, the biggest daily loss in 12 years. Still, gold has surged about 50% in 2025, cementing its status as one of 2025's top performing assets. The price increases are a reaction to major policy, geopolitical, and economic developments this year, including tariffs, the Israel-Hamas conflict, concerns about the Federal Reserve's independence, and the U.S. government shutdown. Morgan Stanley Research expects the rally to continue and revised its 2026 gold forecast upward to $4,400 per ounce, a significant increase from its previous estimate of $3,313. The new projection implies an additional gain of about 10% from early October to the end of next year. I don't know about you guys, but the fact that all big banks are screaming bullish headlines lately is starting to become a massive red flag in my book that gold prices could take a deeper dip this time. What do you think? See, investors are watching gold not just as a hedge against inflation, but as a barometer for everything from central bank policy to geopolitical risk, says Morgan Stanley Metals and mining commodity strategist Amy Gower. We see further upside in gold driven by a falling U.S. dollar, strong ETF buying, continued central bank purchases, and a backdrop of uncertainty supporting demand for this safe haven asset. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
Physical metal tomorrow, and if he hasn't got it, he's got to go and lease it from somewhere. The lease rates have shot up. I mean, typically they were sort of up to 30, 40%. And there's some reports of them going up to 100% and more, basically saying, there's no more left to lease. The other thing, of course, is that we see a backwardation, which by definition is when the spot price is above the futures price. And people got very excited with that being over $3 at one stage, which, of course, would prompt arbitrage. I mean, people with silver sitting in COMEX warehouses would think, okay, we'll ship some of that over and make on the arbitrage. So there've been lots of stories about that. Now, how true they are or whatever, I honestly don't know. I'm sure there's a bit of it, but it's probably exaggerated. What I would say is that the backwardation of spot over futures has actually declined now to around about $1. So it's come way, way down. It still indicates that there is a shortage. In other words, a squeeze on those who are short. Because the problem is that the vast majority of the silver in the LBMA vaults is ETF silver. And the other thing which puts additional pressure on the system is, of course, people look at silver, they see silver going up, they probably think they've missed gold, and therefore the silver is a cheap way in. So they run out and buy ETFs. ETFs have to source the metal. And I think it was last week we heard that a number of ETFs, silver ETFs in India, suspended share creation because they couldn't source the silver. And I think on that basis, I mean, really what we see is that silver is too cheap for these deteriorating monetary conditions. That is that is absolutely clear. It is therefore going higher. But the question is, you have to ask yourself, I mean, as the price rises, what are people going to do? Are they going to just take profits? Or are they going to say, I'm going to hang on to my silver because things are not looking so good for the fiat currencies, for the dollar, whatever. Gold is going up. Gold-silver ratio currently 84, should be below that. Why should I sell my silver? So I think it's a situation which actually, particularly through the growth of ETFs, a rising price could lead to further demand and less supply, because the supply always has been from weak holders in the paper markets. So I think, Jesse, this is a fascinating situation. It's what they call a Giffen good, something which reverses the normal supply and demand relationships on price.
Massive news from India today. India unleashes silver as bank collateral with 10-to-1 gold-silver ratio, boosting global money roll. India formally recognizes silver as bank collateral with a 10-to-1 gold-silver ratio, reshaping lending, boosting demand, and igniting a new era for silver as a global monetary metal. India has taken a historic step toward the monetization of silver, officially allowing the white metal to serve as collateral for bank and non-bank loans under new Reserve Bank of India regulations set to take effect in April 2026. The move effectively establishes a 10-to-1 silver to gold ratio in collateral lending, marking the first time a major economy has formally recognized silver's role alongside gold in modern banking. Silver joins gold in India's banking system. For decades, Indian households have relied on gold jewelry as a primary form of collateral for personal and business loans, especially in rural areas with limited access to credit. The new rules expand that privilege to silver jewelry and ornaments, enabling borrowers to pledge up to 10 kilograms of silver or 1 kilogram of gold as collateral for loans of up to 2.5 lakh, approximately 3,000 USD. The policy applies to both banks and non-banking financial companies, a sector that services millions of small borrowers, and introduces uniform valuation and documentation standards to ensure transparency. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
If you want to trade this market, you'll get killed. It's as simple as that, because they're far cleverer people than you with big, deep pockets who will push things around. And, if they reckon you're in there, they'll kill you. So really, I think you've got to take, if you like, a more sensible view as to actually why it is that you own gold or silver. And the only justification for that, because they are at a premium price, is because they are money. They are legal money. They are final settlement without counterparty, as opposed to credit, which is what a fiat currency is. And if you reckon that the situation for fiat currencies is deteriorating, then that's the reason to hold on to gold. And, whether it sort of goes up 5%, falls 5%, is completely immaterial. The thing to bear in mind is that the value of gold is relatively constant over long periods of time. It is the value of fiat currency which alters, and that has been declining very significantly, particularly since 1971, when the Bretton Woods Agreement was abandoned. So in dollar terms, I mean, you had $35, that was the official rate, $35 to the ounce, and we're now looking at nearly 4,150. I mean, that tells you basically that a 1971 dollar, or rather the dollar today, is less than 1% in its value of the 1971 dollar. And that's what you've got to keep bearing in mind. It's not a situation that is going to change in favor of fiat currencies. That's for sure. Politically, it would be impossible for any government, in the G7 anyway, to reverse the decline in their currencies. They've been educated, I think, by the macroeconomic establishment, which really started with John Maynard Keynes, to, if you like, use a weak currency to benefit the economy, to stimulate the economy. They're not going to change for that, particularly when freed from the constraints of a gold standard, that they can issue as much debt as they want. And that's what they're doing. So you've got an accumulation of debt, and that's where the crisis now is. What's going to happen to the value of that debt? The other side of that debt is the value of the currency. Debt equals credit. Credit is the currency, and also loans underneath that, which businesses have taken out, individuals have taken out, stock market speculators have taken out. It's the value of that credit which you've got to question. You've got to keep your eye on that. So, short answer to your question is that stackers should maybe say, well, thank goodness we've got a sort of situation which means I can, save a bit more out of useless credit and put it into real money. Let's hope this pause goes on for some time, and then I can really sort myself out. I think that's the way to look at it, not to be spooked by what's going on, if you like, in up 5%, down 5%, whatever.
What do you think of today's show? Do you believe that the current gold and silver sell-off is some sort of coordinated attack against the metals, as Alasdair says, or on the contrary, is just big players taking profits after an abnormal rally? Post in the comments section your plan for gold and silver, and share with the stackers if you are taking any profits after the mega rally we experienced this year so far. Now, peep this video right here because it's a perfect fit for you, and I'll see you on the other side.